Welcome back to the Brent Bruce Daily. Today is January now the 30th, 2023. It is 1:33 p.m. Central Time, and we got to take a look and see how things are going. We are now coming to the end of January, and earlier during this month, in the very beginning of the month, I mapped out what we would be seeing in January, starting with the PPI, the producer price index, then moving on to the consumer price index, then to the personal consumption expenditures number, and then ending actually February the 1st with the next announcement from the Federal Reserve as to what they're going to do with the federal funds rate. In general, we have had really muted responses. I guess I would kind of say we've been fouling off these reports. So they're not strikeouts, they're not home runs. We're just fouling these reports off, and we've been very steady, but not seeing the improvement to home loan interest rates that we want to see. Now we're coming up against the number one indicator right now, the thing we're watching the very most, which is the moves by the Federal Reserve and also the comments that we're going to hear on Wednesday, which is the day we're going to get the announcement. Well, we're also going to get the comments from Jerome Powell in his press release that he does after the announcement of their either movement or not movement in the federal funds rate. So right now we are highly expecting that the federal funds rate will go up by 0.25%, which is good. That is what we want to happen as they continue to fight inflation. That should be something that is well received by the bond market and the mortgage-backed securities. But what's going to be important is hearing the comments from Jerome Powell. So if he says that, that he's not seeing inflation coming down, that the response is not strong enough to the moves that they've made so far, that's when we might see a negative response from the bond market and the mortgage-backed security market. If we hear something saying, we do see that inflation is coming down, that's going to allow us to believe pretty confidently that we may have one more adjustment to the federal funds rate of probably 0.25% later here in the next couple of months, probably in February, March timeframe, and then they will pause. They will pause changing the federal funds rate for a while and actually let these moves that they've made sink into the economy. And then later on, probably in 2024, maybe late 2023, they'll be able to start bringing the federal funds rate back down, which is what we want to see happen. But this is a long game. This is a couple of years that we're going to see this get played out. So let's take a quick look here at what we have going on. I'm going to take a look here at the Wall Street Journal today. So the New York Times. So here it says smaller rate increase by the Federal Reserve is likely as inflation cools. So when you read articles right now about the movements that the Federal Reserve is expected to make here on Wednesday, it's pretty consistent that people are saying, whether you're talking about, professors or other economists, that people are consistently saying inflation is cooling. Inflation is cooling. They're seeing that in the numbers. They're seeing that in the CPI and the PCE. They're seeing that coming out in the reports. So we're just hoping that the Federal Reserve doesn't do what they're known for. And that is basically they're always looking in the rear view mirror as they're driving forward. So they're looking at in the rear view mirror and they may say, well, I don't see it coming down just quite yet, because they're not looking forward as to what is going on right now. Now, the reports that have come out now have been consistent. So it would be very difficult, even in looking in the rearview mirror, to not acknowledge that inflation is coming down. So that's what they want to hear. And actually, it will make them seem like very, very smart people, because it seems like they may have an opportunity of bringing inflation under control without it being a complete disaster to the markets. So let's take a look and see where we're at on our charts right now. We're currently down 23 basis points. I believe we're just seeing a preparation for the risk that comes along with a Federal Reserve announcement and comments by Jerome Powell afterwards. The 10-year Treasury is following suit, up 3 basis points. But as we take a look closer at the technical indicators, we can feel pretty good where we are. You can see how long we've been here in this range. Now, this was that great report that we received on the employment numbers, showing that income-based inflation was subsiding. That was our last really good run. In here, we've had the PCE come out and the CPI come out, but again, just not enough to break us through this Fibonacci level at 101.671. Here we're sitting now with 2 floors under us and a little bit of room to run before we hit the Fibonacci level again. So I think we're really just gearing up to what we're going to see coming out on Wednesday. And I really hope that we're going to have a report come out and comments that are well received by the mortgage-backed security market so we can break through this Fibonacci level and start to fight with this 200-day moving average, which we keep talking about. We want to get into that fight soon. So let's take a look and see where we're at on our actual interest rates. Right now, let's go ahead and run the Brent Bruce Daily. Very well qualified, conventional 30-year fixed, 800 FICO score, 25% down, single-family residence, primary residence. We are currently at 6.125. Just a broken record here. We've been at 6.125 or right in that range. It seems like all of January, we were right about in that range, just not able to really consistently stay below that 5.99 number. So what if we were to open this up a little bit? Let's take a look at what it takes to get to 5.99. Right now, for $1,000, you're getting a 5.99 for a very well qualified 30-year fixed conventional. And if you were to pay a point, you're about 5.75%. So still very good. I mean, it's great that we're not talking more about the 6.25s and 6.5s. The 5s are definitely attainable, especially with the sellers offering concessions like they are right now on the purchases for us to get down here into the 5.7 range. Also, just in case you're sure you're hearing about this, we also have the 2-1 buy down options, which is where you get a lower payment for the first year and the second year before it comes back to whatever the actual rate is. Like, for instance, if it's 6.125 today, it would take 2 years before you'd start to see that interest rate payment based on 6.125. Whole other topic, but that's another option for you as well. We are going to be gearing up here and getting ready for the big Fed Reserve announcement that is going to be coming out on Wednesday. Their meeting will start on Tuesday, and the announcement will be on Wednesday. So that's what we're going to be watching for. I'll give you another heads up tomorrow as we kind of make our game plan, talk more about what we're hearing, and I will see you then. Have a good day.